Good day, everyone. My name is Adam Livingston. I am the Bitcoin Wizard, and I believe this will be Bitcoin's mildest bear market ever. And if you are newer, especially if you bought in late 2025, your nervous system is probably screaming a bit. That makes total sense because your screen has been red for months. The timeline right now is a firing squad, and every bounce feels like it could vanish in an hour. So I want to start with something grounding today. Bear markets hurt for one main reason, and that is uncertainty. When the price draws down, your confidence draws down, and then your brain starts running these future scenarios like it's a disaster simulator. The experience is real, and that deserves some respect. But this is the point of today's presentation. I am going to give you a data-first walkthrough of why this bear market is shaping up to be historically mild, even if it still feels intense right now. The simple thesis really is that Bitcoin is maturing in real time, and market maturity shows up first through volatility compression across the entire return distribution of the asset. Early Bitcoin traded like a thin market with a fragile holder base. Back then, a relatively small wave of selling could create giant percentage collapses. A relatively small wave of buying could create that absurd vertical upside. But as the asset grows, something mechanical happens. The market cap expands, the market depth expands, institutional participation expands, derivatives deepen for the asset, long duration holders increase, and capital becomes more patient and more professional. And when all of those ingredients, they start to scale, the same dollar flows produce smaller percentage moves. And that one idea explains everything that I'm going to talk about today. I'm going to explain why upside behaves differently in late cycle euphoria. I'm also going to explain why the downside is going to behave differently during panics. And I am also going to explain why bottoms increasingly arrive through fast flushes and stabilization instead of long multi-year spirals. I am going to prove it through 3 layers of evidence today: drawdown, compressions, realized volatility decay, tail risk collapse, all using historical Bitcoin price data. And then I will layer on the supporting signals. I'm going to talk about how when sentiment hits this level of extreme fear, the drawdowns remain comparatively contained, how the key technical regimes behave when liquidity and hedging capacity are deeper, and I'm going to talk about why the market repeatedly finds floors faster when supply migrates towards stronger hands. So there is comfort in all of this, especially for the people who feel emotionally wrecked. The fear feels enormous because your brain measures risk emotionally through uncertainty, but the data measures risk through distributions and probabilities, and I am going to give you the second one. So this slide is really the scoreboard. This slide is showing the peak to trough drawdowns across Bitcoin's major bear cycles, cycle by cycle, and the pattern is almost embarrassing in how clean it is. Back in 2013 to 2015, Bitcoin topped around $1,163 and bottomed around $152 for an 87% drawdown. That era was the true wilderness. Thin liquidity, tiny market cap, fragile order books, and a holder base that could get vaporized by a single wave of forced selling. And then we fast forward to 2017 through 2018, Bitcoin peaked near $19,783 and bottomed at $3,122 for an 84% drawdown. Same story, bigger than before, yet small enough that panic and leverage cascades could carve out those biblical levels of decline. Then 2021 to 2022, Bitcoin peaked around $69,400, bottomed around $15,480 for a 77% drawdown. Still brutal, still deep, but the direction has been clear. The crash profile continues to compress as the asset scales. Now we look at the current cycle, 2025 to 2026, peak around $126,000, bottom around $59,978, about a 53% peak to trough drawdown. Now that 53% number is the headline right now because that number feels horrific in the moment, yet it historically sits in a very different category than the old Bitcoin bear markets. And this is what happens when an asset just grows up and matures. The market cap gets larger and liquidity gets deeper, the price becomes harder to shove around. The market absorbs forced selling with less percentage damage, and then the supply that used to be held by the weak hands migrates towards stronger hands, and the floor forms faster. So this is establishing the historical trend that the Bitcoin bear markets continue to get milder cycle after cycle. Have we totally bottomed yet? Maybe not, we might wick lower just a little bit, but when you look at a lot of the indicators that we'll be discussing, well, it seems like the bottom is near. So drawdown compression really is the visual, but realized volatility is the engine. We need to ask, what does the Bitcoin volatility data say about where this trend goes next? This really is the structural centerpiece of my entire argument, because drawdowns are what people remember, yet volatility is what creates drawdowns. Obviously, volatility is the underlying weather system. So this slide shows you the realized annualized volatility across the three big windows, measured from daily log returns, annualized by the square root of 365. In plain English, I wanted to capture how violently Bitcoin has actually moved day after day across each era. And here are the numbers. From 2015 to 2018, realized annual volatility was about 76.6%. From 2019 to 2022, it sits around 74%. And then from 2023 to today, it has dropped to 47.3%. That is a massive shift, roughly a 38% decline in realized volatility, and that trend matters a lot more than any single narrative because it is a market structure signal. It is the market telling you that the asset has matured enough that the price swings compress. Now, here is why this happens. Because Bitcoin grew from that niche asset into something with far more depth, far more participation, and far more institutional flow, especially after the ETFs came to the forefront. Volatility compression dampens euphoria and dampens the panic. What did we see in Q4 of 2025? We saw an all-time high in USD at 126K, absolutely. But we know that the entire asset holder base was expecting a much bigger blow off top. But volatility compression is reducing the frequency of the vertical face melters on the upside, and it's reducing the frequency of multi-month liquidation spirals on the downside. And this also explains why this 2026 downside has behaved differently so far. The sell-off has happened, it has flushed, it hit fear, and then the market found footing faster than the old regime. Because right now, whether you look at the relative strength index, the fear and greed index, the power law distribution, we are seemingly at a bottom despite a much lower drawdown in percentage terms. So it seems like this bear market isn't going to be mild by any wishful thinking on my part. It's mild because the statistical regime has totally shifted, and the deeper implication is very powerful. When realized volatility structurally declines like this, the entire distribution of returns tightens, which means drawdowns tend to compress and the tail risk events tend to fade. So now it's time to talk about the tail risk and how it's disappearing from the price distributions. And this really is where the market maturity story becomes undeniable, because we are looking straight at tail risk, the extreme daily moves that used to define Bitcoin's entire reputation. So what I did is I decided to track the percentage of days in each cycle where Bitcoin moved more than 5, 8, and 10% in a single day. The different colors are representing all of the different years. The lighter, the orange color, that is the latest regime of 2023 to 2026. And then all of the different clusters are the 5%, 8%, and 10% moves in Bitcoin. And the trend is very obvious. It's going down. These are the days historically that created legends of trauma, the liquidation cascades, and the feeling that reality is bending. And this is what the data shows. In the older cycles, the daily moves above 5% were very common. In 2013 to 2015, about 15.2% of all days in that time span had a move greater than 5%. In 2017 to 2018, that fell to 13.7%, and now in the current cycle, it has dropped to 5.7%, the 5+% of price movement of Bitcoin. So now we look at the bigger moves. For the 8% days, we went from 7.8% of days in this regime from 2015 to 2018 to only 1.9% of days. That is a 76% reduction in the 8% daily moves. But now the real mic drop, which is the 10% days, the true chaos events. We went from 2013 to 2015. Bitcoin moved 10% or more in 3.56% of all the days in that regime. We went from 3.56% to 0.26%. That is a 93% reduction in 10+% days. So this is statistical proof that the extreme ends of the distribution are getting shaved down over time. The market is losing the explosive lottery ticket tail, but it's also losing the catastrophic wipeout tail at the same time. And once you see this, you can start to explain why this bear market is behaving the way that it is. Because the brutal bear markets from the past were powered by the repeated tail events stacking on top of each other. One big down day triggered liquidation, which triggered more down days, which triggered the more margin calls, forced selling, the panic selling, and then the entire thing became a slow motion cascade. But when tail events become rare, that means that cascade becomes harder to sustain. And that also changes how bottoms form. So when people say Bitcoin is less insane than it used to be, this is what they mean. The market still moves, absolutely. The market still scares people. It's a lot more volatile than the S&P 500, yet the frequency of truly extreme days has totally collapsed. So when the sentiment is hitting maximum despair, the actual price damage is a lot smaller than prior cycles. This bear market has a very specific signature, a violent flush. We've seen extreme fear and then a quicker stabilization process so far than the older cycles. So let's anchor the facts. If we bring in the 200-day moving average, because that is the classic regime line for Bitcoin, it is the dividing line between the long-term uptrend behavior and the bear market territory. Right now, the 200-day sits around $92,400, and the price has been trading roughly 30% below that number. And that matters because the 30% below the 200-day tends to represent the real bear market conditions. The difference this cycle is the drawdown depth at the same structural moment, however. In prior cycles, when the price started interacting with that 200-day line from below during the bear process, the drawdown was often already in the 70 to 80% zone. This cycle, the drawdown at the low is roughly 53%, so the market is reaching the classic bear regime technical zones with less damage than the historical norm, and that lines up perfectly with the volatility compression story. Now, if you look at RSI, this gives you a clean view of how long oversold conditions persist. On February 5th, 2026, the 14-day RSI hit 23, which means deeply oversold, but then we saw it recover quickly toward the 40 area, which is a distinctive bottom signature. In 2018, the oversold readings persisted much longer. In 22, the oversold conditions showed up repeatedly with multiple retests throughout months, and the bear process took a lot longer to resolve. But so far, that one oversold event that we have seen was sharp and short-lived. The RSI is still indicating levels of oversold, obviously, but again, it seems like that all of these indicators are marking along with a shorter drawdown in percentage terms. And these technical indicators aren't magic, they are reflections of behavior, because when liquidity is deeper and the holder base is stronger, the market can exhaust sellers faster. So this cycle's bear process has the same emotional intensity, yet it's carrying a different mechanical fingerprint. We are seeing the classic bear regime signaling with the shorter oversold duration and quicker stabilization so far. The crypto fear and greed index hit 5, which was extreme fear, which matched the exact sentiment readings at the 2018 and the 2022 cycle bottoms. Now that despair signal is identical. The structural destruction underneath is absolutely not identical. The 2018 bottom aligned with fear and greed around 5. The 2022 bottom, to be precise, aligned with the fear and greed around a 6. And yet now we're sitting at a 5 again. So we are at a worse point in the fear and greed index than the depths of the crypto winter in 2022. So the sentiment is literally printing a generational low type reading. Now, if we look at the price damage paired with that same emotional reading, 2018, the drawdown was in the 80% range. In 2022, it might have been in the 70% range. And now, so far, it's 53. And that combination is the maturation signal here, because the market is hitting maximum despair emotionally, while the structure that has been built, it's preventing the maximum destruction mechanically. And that's what happens when Bitcoin becomes larger, deeper, and more institutionally held, because the retail emotion can still swing to extremes. The fear still becomes total, yet the price path becomes harder to push into an 80+% death spiral, because the market has more depth, more hedging capacity, and more patient capital sitting underneath. The emotion is telling you that the crowd is exhausted. The structure is telling you that the floor is stronger than it used to be. So all of the bears claiming that Bitcoin is going to 25K or 30K, you will be shattering every single sentiment marker occur historically. You'll be shattering every model, including the power law, and they'll be ignoring the drawdowns compressing historically. They'll be ignoring the realized volatility failing, the tail risk collapsing, and they're just ignoring that this bear regime is just going to behave differently because the asset now has a fundamentally different market structure. Bear markets still feel horrible because uncertainty feels horrible. Yet the data suggests that the definition of Bitcoin pain is evolving as the asset scales. A mature market can still scare you, it can still flush you, it can still create moments where the world feels like it's ending. Yet the probability distribution looks different than it used to. The worst outcomes have less space to express themselves. So my closing message is this: every additional week that the Bitcoin holds below its cycle low while sentiment remains pinned at extreme fear strengthens the case that the bear market has already entered a new structural era. That's why the title of this video is what it is. Welcome to the mildest bear market in Bitcoin history. And for anyone who's been around for those older cycles, that single sentence carries a hidden meaning. The accumulation phase becomes clearer, faster, and more mechanically supported than it ever was in the early years. The indicators are showing that it's prime accumulation time, and if you want to be positioned before the Great Rotation, Swan Private is for you. Swan Private helps high net worth families and individuals be secured in a Bitcoin position securely and strategically. If you want to be paired with a professional before the next rotation happens, go to swan.com/no-second-best to learn more. My name is Adam Livingston. Thank you so much for tuning in today's transmission of the Orange Gospel of Bitcoin. Please like this video and subscribe to Swan, where we bring you the daily Bitcoin insight with more energy than anybody. Have a terrific day. Do not party too hard. Class dismissed.